Howdy, everybody. Welcome to Liberty Call. Today is Wednesday, August 28th, 2024. Hope you're having a fantastical day out in the interwebs. It's another sunny day here in Colorado. A little warmer than yesterday, but still, I'll take it. I'm a little sweaty. I just finished my workout, so if I pass out during this broadcast, I apologize. I'll wake back up and finish it later. Anyways, hope you're having a good day out there. Market's not in a good mood today. And before we jump in and get started, if you in the yellow shirt, if you could do me a favor, give me some thumbs up, a like, a share, subscribe, a follow, and press that notification bell. Again, I'm a little out of breath. You know, when my piece of free advice today is when you're working out, listen to Anthrax Among the Living album. It is excellent. My wife probably is not very happy because I played it very loud and she closed the door to the bottom of the stairs. All right, let's go ahead and jump into the numbers. Dow Jones was down 0.39%, 159 points, closed at 41,091. S&P 500 down 0.6%, 33 points, closed at 5592. NASDAQ down 1.14%, 202 points, closed at 17,552. The VIX was up 10.89% today. It's at 1711. Canada down 0.57, Brazil up 0.44, and Mexico down 0.07. In Europe, Germany was up 0.54, the UK down 0.02, France up 0.16, the Netherlands up 0.31, Spain up 0.05, Italy up 0.3, Switzerland up 0.39, and Portugal down 0.41. Russian exchanges both red again today. The MOEX down 1.05, the RTSI down 1.01. And the Asian markets, the Nikkei in Japan was up 0.12, Australia flat at 0, New Zealand up 0.22. In China, the Shanghai was down 0.4, Shenzhen Component down 0.31, China A50 down 1.04, DJ Shanghai down 0.34, Hang Seng down 1.02%, and the Taiwan weighted down 0.25%. All right, so those are the markets for today. Kind of not great. So let's hop into the market recap. S&P 500 closes lower as chip stocks lead the tech wobble. The S&P 500 closed lower on Wednesday, primarily driven by a downturn in the tech sector due to NVIDIA's pre-earnings jitters. NVIDIA, a key player in the AI technology, saw its shares fall 2% as investors braced for its quarterly results, scheduled to release after the market closed. The company is expected to report earnings per share of $0.644 and revenue of $28.68 billion, reflecting significant growth from the previous quarter. NVIDIA's drop was compounded by a 19% plunge in Supermicro Computers Inc. stock following a delay in its annual results and scrutiny over accounting practices and controversial shipments flagged by short seller Hindenburg. The retail sector showed mixed results. PVH, the parent company of Calvin Klein and Tommy Hilfiger, saw its stock decline over 6% after reporting a fall in second quarter sales. Bath & Body Works also dropped 7% following a cut in its annual sales forecast, attributed to reduced consumer spending amidst high inflation. Abercrombie & Fitch experienced a 16% drop as its CEO highlighted a challenging macroeconomic environment despite an improved sales forecast. Conversely, Kohl's saw a marginal gain after surpassing earnings expectations and raising its annual profit forecast. In contrast, Chewy stock surged 11%. Hey, we just bought from them, so I'm glad to help out Chewy. On the back of strong earnings exceeding market predictions, cryptocurrency-related stocks like Coinbase, Riot, and MicroStrategy fell as Bitcoin dipped below 60,000 per coin, with investors taking profits ahead of NVIDIA's earnings report. All right, so kind of a mixed day, not terrible. I mean, companies are showing that they're in the retail sector, apparently starting to have some weaker numbers, which not surprising. People have less money. Are you going to spend it on, Gap jeans or, food? It's one or the other. Next up, article from Zero Hedge, 2,000 workers gone. Klarna is the first major company to unleash mass layoffs thanks to AI. All right, let's see what this has to say. Last March, Goldman Sachs chief economist Jan Hatzius highlighted the potential impact of AI on employment, estimating that generative AI could affect up to 300 million jobs globally. This forecast is now beginning to materialize, with Klarna, a Swedish fintech giant, leading the charge in job cuts due to AI. Klarna has recently laid off over 1,000 employees and plans to reduce its workforce from 5,000 to possibly 2,000, leveraging AI to handle tasks like customer service and marketing. CEO Sebastian Simiakowski, sorry if I said that wrong, praised AI's role in narrowing Klarna's net loss and boosting revenue per employee from 400,000 to 700,000. The company's embrace of AI aligns with its strategy as it prepares for its initial public offering, potentially raising its valuation from $6.7 billion to between $15 and $20 billion. Wow, that's a lot. While AI's cost-saving benefits are clear, Klarna's approach also underscores broader concerns about job losses and economic displacement. While other companies are likely to follow with other companies likely to follow Klarna's lead, the anticipated wave of layoffs could exceed Goldman's initial $300 million estimate. The rise in AI-driven efficiency could prompt widespread workforce reductions across industries, signaling a significant shift in the job market. Personally, I wouldn't worry too much. Someone has to fix the computers. I mean, it's like the old days, 120 years ago when we were, the automobile was starting to come into the consumer market. And, people were, oh my God, or first people were worried about all the horse crap all over the streets. I mean, it was a big worry in places like New York City. Are we going to be up to our, eyeballs in horse poop? And then came along the horseless carriage, which, kind of reduced the need on horses for day-to-day travel. And, the more we use cars, the less we use horses. I mean, and it put the horse and buggy out of business. I mean, my grandmother's dad was a harness maker at the Rock Island Arsenal in, Western Illinois back a long time ago, before she was born. And, that job went out of business by the time the Second World War came along. So, things change, but people adapt, and there will always be, positions available as long as you're nimble and are willing to learn. All right. Okay, let's get to the next article, also from Zero Hedge. Yield curve shifts offer signals for stockholders. This was written by Michael Leibowitz of realinvestmentadvice.com. So let's see what he has to say. Michael Leibowitz discusses the implications of recent changes in the U.S. Treasury yields and the yield curve for investors. Recently, short and long-term Treasury yields have fallen, leading to a bull steepening of the yield curve, where short-term yields drop more than the long-term yields. The shift reflects expectations of a weakening economic conditions, moderating inflation, and a potential rate cut by the Federal Reserve. The yield curve is a crucial indicator for bond investors, showing expectations for economic growth and inflation. Historically, the yield curve steepens after recessions and flattens during expansions. An inverted yield curve, where the short-term rate exceeds long-term rates, often signals a looming recession, which we've had an inverted yield curve since the summer of 22. So currently, a bull steepening trend suggests that investors anticipate the Fed will soon lower rates due to economic weakness. Leibowitz outlines different yield curve shifts: the bull steepening, decline in all yields with short-term yields falling more; a bear steepening, rise in long-term yields more than short-term; a bull flattening, long-term yields fall more; and a bear flattening, short-term yields rise more. The current bull steepening indicates that markets expect the Fed to cut rates, potentially improving bond prices, but raising concerns about future stock market performance. In summary, while the bull steepening trend signals a potential Fed rate cut, it may also indicate underlying economic challenges that could affect stock returns negatively. Leibowitz will explore these impacts in detail in the next part of his analysis. Yeah, usually the markets do not react positively after a rate cut, and you usually see markets trend downward. So again, history doesn't always repeat, but it does rhyme. So, again, be careful out there, folks. And one last article here, also from Zero Hedge, 5 Signs the U.S. is Collapsing, written by Clark Barnes. So see what he had to say here. Clark Barnes explores the current state of the U.S., arguing that the nation is in a precarious condition despite its historically optimistic spirit. He highlights several key issues contributing to this instability. Number 1, political division. The U.S. has experienced unprecedented political polarization, with extreme views dominating the discourse. Unlike the more unified goals of the past decades, current political debates are marked by intense partisanship and animosity. Number 2, violent protests. Protests, once characterized by peaceful demonstrations, have increasingly turned violent, 2020. Barnes notes a troubling trend where protests often escalate into riots with armed participants targeting institutions and individuals, reflecting deeper societal discord. Minneapolis, 2020, summer of Floyd. Infrastructure decay. U.S. infrastructure is deteriorating due to years of underinvestment. The power grid in particular is outdated and vulnerable, exacerbating concerns about the country's ability to handle future challenges. I'd stop there and say, where in the Constitution is there, does the federal government have authority over the power grid? Now, you can make an argument for transportation because that has to do with commerce, but power, that seems more like a local issue. But again, I'm just someone who's read the Constitution more than once. All right, number 4, moral decline. Barnes argues that societal morals are eroding. That's not really surprising. With a growing number of people rejecting the values of hard work and honesty, he points to an increasing crime and leniency of legal systems as indicators of this moral decay. Unless you're a conservative and then you go to jail for walking through the Capitol building when you weren't supposed to. Economic instability. Despite being a leading global economy, the U.S. is grappling with significant debt and economic inequality. I don't care about being unequal. Government borrowing is escalating, and the national debt is approaching, 32 trillion. It's 35 trillion. That's not right. 35 trillion, creating fears about the financial stability. Barnes concludes that while the U.S. has not reached a point of no return, it is dangerously close. Without significant reforms, the country risks severe economic and societal collapse. Personally, I think we're past the point of return. I don't think it's savable at this point. We really just need to, break up the republic, let the lefties go where they want to go, let the righties go where they want to go, let the libertarians like me. I'm sure there's going to be more than one libertarian state out there because I find a lot of conservatives are actually pretty libertarian when you get past all the being such war hawks. They're actually, live and let live and really don't care about a lot of the stupid stuff that, the state likes to arrest people for. So anyways, all right. Well, that's everything that I had for today. If anyone needs anything from me, wait. Go to DSAFinancialGroup.com. All your financial needs and retirement and education and all that good planning can be done there. So feel free to give me a buzz. I'd be happy to give you some help. All right. Well, that's, like I said, everything that I had for today. Me and my man Jake back here, who's asleep upside down. He's really shirking his security duties today. We're going to go out and play a little fetch and enjoy the rest of our afternoon. So I hope everyone out there has a wonderful evening, and I'll talk to you next time. Adios.